Okay, so I am making this video at the request of some of my students, um, and I am a little. I've taken a little bit of time trying to figure out how to do this. My goal here is to kind of explain what the lack of making adjusting journal entries does to the accounting equation or to assets, liabilities, equity, revenue, and expenses. And this is in response to one of the homework problems assigned to them. And so this is what I'm gonna try to explain this. I've thought of a while trying to figure out how to make this happen. And so I think I got it down. Let's let's just take a first example of doing a journal entry related to um, supplies. Let's do that first. So when we have our supplies account, I'm going to use this T account right here, supplies. All right. And then so for dealing with supplies, we're making adjusting journal entries. We're going to need the supplies expense. Remember, we make adjusting journal entries. We do one from the balance sheet and one from the income statement. Supplies is the balance sheet, supplies expense, the income statement. Let's say we had $2,000 worth of supplies. We bought $500 more. We have $2,500 available. At the end of the accounting period, and I'm going to put a little line under here to signify that this is the balance. Let's say we have 1,200 left, okay? This is what we know because we sent someone around to count it up. Well, the adjusting entry then, if this is 25, we got to take 2,500 minus 1,200. So we know that 1,300 was used, and we need to make this journal entry for supplies expense, okay? This is the number, these numbers here, the 200, the 2,000 and the 500 have been recorded in the books. But we have on our books right now that we have 2,500. We only know this ending balance because we counted it physically. So if we don't make this journal entry, the journal entry I'm going to put over here is going to be a debit to supplies expense and a credit to supplies. And it's for 1,300. All right. Let's first look at what would happen if we didn't make this adjustment to supplies. If we're basically saying we didn't care about our account, all right, then we're going to show we have 25. Our balance is going to show that we have $2,500 worth of supplies, when really we only have 1,200. So so 1,200 is what it should be. So we're saying that our supplies are 2,500, but it's not reality. We're overstating our assets because supplies is an asset. Now, if we didn't make this supplies expense, remember expenses the increasing an expense decreases overall assets. I mean equity, excuse me. So holding revenues consistent. Let me make that really quick. Revenues, expenses, net income. All right. So if revenues, regardless of the situation, was $500,000, I guess I should make this look like, we'll just do it like that. All right. So revenues were $500. Without making this expense adjusting journal entry here, without doing that, let's say that our expenses were $270,000. Then we're saying net income is $230. This is excluding adjustment. Oh, I guess I didn't need to merge it since I. I don't know what I did. Messed that up. There. All right. So excluding the adjustment, our net income is 230. Including we include the adjustment. Our revenue is holding the consistent, but now it's going to be the 270,000 plus the adjustment we made. Now our net income, if we have the adjustment, is going to be less than what we're saying by not making it. So clearly, using this example, our expenses are understated. We should have had more than we reported. So expenses are understated. Understand. Revenues are not impacted. Liabilities are not impacted. Now, how does this impact equity? Remember, revenues minus expenses equals net income. Sorry. Keep getting dry mouth. We are going to move our net income to our statement of owner's equity. And so it's the statement of owner's equity is the ending balance, is what we're putting here in the balance sheet. So we have our beginning balance plus owner contribution plus net income minus withdrawals equal to our ending balance, right? That's the formula we use for our statement of owner's equity. So beginning balance, let's say, was 0. Our owner's contribution was $50,000. Let's format all this. Oh, thought I clicked the right thing. All right, so here's our situation. Net income, if we exclude the adjustment, oops, it's going to say that we had $230,000. And let's say withdrawals, we withdrew 10,000. Okay, just making it up. When we add these together, we're saying that our ending balance on our equity account is $270,000. Sorry, something was on my keyboard and it just fell inside, which was never good. Now, if we're including the adjustment, everything else held constant. All right, I don't need to do that. 0 beginning balance. Owner's contribution was the same, but net income now with making the adjustment is going to be included. What did that do to our ending balance on our owner's equity account? Well, if we included it, our correct amount, you know what, let me just make this consistent really quick. All right, I really tried to think this through before I did this video, but even as I do it, there's things I find. Anyway, if we exclude it, we've overstated our equity because we say our equity is 270,000 when it really should be 268,700. So we're overstating our equity, right? And that's how we do our supplies expense. All right, so let's look at let's change this up and let's do depreciation. Okay. Okay, so cumulative depreciation, I need to merge this, wrap it there. Cumulative depreciation is a contra asset account, right? So this is going to be a little different how this is going. Our journal entry, let's say beginning balance of accumulated depreciation was 0. It's credit balance, depreciation expense. So we're going to record our depreciation. To record our depreciation on this, we are going to watch this. I'm going to save me some time going forward. All right. Let's just say it was $5,000. Okay. So we should make this journal entry. Debit to, well, I guess that wouldn't work. Depreciation expense, credit to accumulated depreciation. All right. Oh, what is that? I thought that was something on my screen. Okay. So $5,000 is what we should make. Okay. So what happens if we don't make it? Well, if we don't make it, so it should be that the accumulated depreciation has 5,000 and the depreciation expense has 5,000 in it. But if we don't, then we're showing a 0 here. Well, accumulated depreciation is a contra asset account. So let's say it's tied to a vehicle, and let's say the vehicle had a historical cost of $40,000. Okay. Then we should show accumulated depreciation of minus 5,000 for a net book value. Yeah, whatever. Net book value, same thing. So we should be showing on our balance sheet my asset worth $35,000. I'm going to grab this formatting over here really quick. Just make it look good. Why did it do that? I clicked it and it's weird. Anyway. Okay, so my net book value should be $35,000. But if I don't make this, then my accumulated depreciation is 0. So this is exclude. No, this is include. We need to let's be consistent with over there. So let's say exclude, include, right? So excluding this, we have a 0 here, and then I'm just going to go like this. And let's make that visible. Let's make that visible. This is what it should be if we include that adjustment. So our assets are being overstated. And then no impact on the liabilities, no impact on the revenues. So again, it's the same thing here, except instead of 1,300, it's a $5,000. So we're in the same situation, whether it was the other supplies or whether it's accumulated or depreciation expense. So our supplies are understated and equity is overstated in this situation. So this is going to be the same for supplies expense, accumulated depreciation expense, any prepaid account, any prepaid expense. This is kind of how it's going to flow. It's going to follow. Let's move now to unearned revenue. Okay. I'm going to go over here and go unearned revenue. And this is just going to be earned revenue or whatever revenue. All right. So in this case, we have received money in advance. And I'm going to actually, let's just get rid of this. Okay. So let's say we have unearned revenue. We've gotten money in advance. Let's say we got $50,000 in advance. And sorry, I really am kind of okay. And then through the course of the accounting period, we've earned 30,000 of this. What we should do is make a journal entry showing that we've debited the 30,000 out of unearned revenue and credited the revenue account of 30,000. That's the situation. Our journal entry should be debit to unearned revenue, credit to revenue. And this should be for 30,000. Oops. Okay. Well, now we're impacting revenues here. So let's change this up now, and we're going to have 270. Okay. Now, excluding this adjustment, if we don't make this adjustment, our revenues are 500,000, but including it, it's 530,000. All right. So if it's excluded, our account balance is going to be, I'm just going to get rid of these because we don't need those now. Excluding that, liabilities, excluding it is going to show liabilities of 50,000. And then excluding it, I guess if we had 500,000 already in here, then all right, there we go. So if we exclude it, then we're basically saying that our revenue was less and our liabilities were more. So our liabilities would be overstated because we only should show 20,000 as a liability. We're showing 50,000. Then our revenue is going to be understated because we should have 530,000, but we're only saying 500,000. Oh, let me clear these out from last time. And then, so we're going to have liabilities, I said, are overstated. Revenues are understated. And now, as we roll the change through, because of the revenue change, if it's excluded, we're saying we have net income of 270,000, which gets, I'm sorry, 230,000, which gets rolled into this ending balance of equity of 270,000, but it should be 300,000. So equity is understated. And that's how we're going to deal with any movement from unearned revenue to revenue. This video is already kind of getting kind of long, and I don't want that. Just apply the same principles when you're doing your accrued revenues and accrued expenses. Okay, accrued revenues are revenues that you didn't know that you had. Instead, so you're going to have an asset over here of accounts receivable. And if you don't record it, let's say it was 0 and you should have recorded five, no, let's do a different number, $9,000, then you're going to show revenues are less, right? It should be 509,000. But this is what you're reporting because you didn't put that 9,000 in there. So first of all, if we didn't put the 9,000, our assets would be 0. So our assets would be understated. I'm just going to type in under. Liabilities not impacted. Revenues are under. And then equity is obviously under. All we're under. And then the other one is accrued expenses, or expenses that we didn't know we had or whatever. We haven't paid it yet, right? We get the bill or something like that. So now we're dealing with a liability, accounts payable, accounts payable. Okay, and initially it was 0, and then it's 11,000. And now you have an expense here. Doesn't matter which one. Let's say it would have been 0, and so the adjustment is going to make it 11,000. So this is a liability. So excluding it, it's 0 as the liability, and it's 0 as the expense. But if we include it, it's 11,000. So we've definitely underreported our liabilities and our expenses. Well, if we do that, then including the adjustment would be 281,000. And remember, I'm just making these numbers up. As we increase our expense, we decrease overall net income. So we're overstating our equity when we don't include our accrued expenses. All right, that's something like a utility bill or something that you've used during the accounting period, but you didn't record. So ultimately, that's kind of what we're looking at. I find for me, it is just easier to come up with something like this and just run stuff through if I'm having a hard time grasping things. Make up fake numbers and then just see what happens when you change the one number that you're looking at. In this case, we were looking at an expense for income. We're looking at the capital and impact on that because net income changes. So we're looking at that change. And then we're making up numbers for the accounts payable and the expense or just whatever ledger accounts we're dealing with. So that seems to help me. Hopefully that helps you. And hopefully this video helps you too. All right, we'll see you guys later.